I welcome you all. And as we always follow in JITO, any meeting or webinar, we start with Navkar Mantra. So I request everyone to kindly recite Navkar Mantra. Ravi, we can start and everybody can have in there. Namo Ariyantanam, Namo Siddhanam, Namo Airiyanam, Namo Vajjayanam, Namo Loe Sabva Saunam, Eso Panch Namo Karo, Avam Papam Panashano, Manglanam Cha Savvesi, Padmam Hoi Mangalam. So, without taking much of your time, I would request our director in charge, Ravi Jain, to welcome you all at this webinar of JPF. JPF has been very active during this COVID-19, and we are bringing before you very good speakers, very knowledgeable and experienced people. And I request Ravi for his welcome address.
Thank you, Ajmera ji. Jai Jinendra. I welcome everyone who are attending this webinar on COVID-19, the way forward for equity and commodity. I welcome our speakers in today's webinar, Shri Raamdeo ji Agrawal and Shri Vikram Dhawan ji. I also welcome all the office bearer of JITO Apex, like as far as I know, Prithviraj ji Kothari is there. He is the JPF chairman. TNAPTS zone and JPF office bearer who are attending this session. In every adversity lies the siege of equal or greater opportunity. Most of the countries in the world are going through continuous lockdown. I believe the lockdown will end soon, but it will leave behind permanent changes in terms of the investment behavior of the investor. In today's panel discussion, we will get a chance to know the viewpoint of the two great experts from the finance domain who know better than anybody that how things are evolving and how to convert challenges into opportunities when you deal with equity and commodities post COVID-19. So, not delaying anymore, I would like request Ajmera ji to proceed with the webinar.
Thank you, Ravi, for your very brief but important message. With this, I will request the dynamic zone chairman Ravikant ji Chaudhary for his welcome address. He is the main host with the JPF today. So, Ravikant ji. Aakash, Ravikant ji is unmuted. What happened? Has he gone out or what?
We have him on the call. He is
Hello.
Yeah, Ravi ji, please go ahead. Ravikant ji, please go ahead.
Yeah, Ravi ji, please go ahead.
Yeah, good evening, Jai Jinendra.
Yeah.
I hope you are all well and safe. It is my pleasure to welcome Shri Raamdeo ji Agrawal, co-founder and chairman of Motilal Oswal Financial Services, and Shri Vikram Dhawan, head commodities and fund manager, Nippon India Mutual Fund, to help us the understanding the impact of this pandemic COVID-19 and make understand and guiding us on the way forward. We hope all of us can make the best of this webinar show. Thank you.
Thank you, Ravi ji, for your very short, brief message. With this, we have, very dynamic personality of JPF. In fact, he is one of the crusader, I would call you, who along with Ravi has brought life to JPF. So I request Ajay Bohra, the vice chairman of JPF, to say a few words about JPF.
Thank you, Ajmera ji, for the generous introduction, which I don't necessarily deserve. Thank you. Well, JITO Professional Forum is a vertical of JITO, which consists of the professionals and gets operated by the professionals. Its members include doctors, lawyers, architects, banking and financial services professionals, chartered accountants, salaried executives, and engineers. Well, when we face these health-triggered economic uncertainties in this interconnected and interdependent environment, the importance of professionals and domain experts get underscored and highlighted. JPF presents a platform where professionals can connect with the business community at large and create the collaborative advantage, which is the key to survive and thrive during and after these uncertain times are over. So with that, we appeal to everyone on this session today. If you know of any professionals, please connect them with JITO Professional Forum so we can co-create more such sessions and help every one of us unlearn and relearn. Thank you.
Thank you, Ajay ji. We have our first speaker already with us now, Shri Vikram Dhawan. And may I request Ankit Ajmera to kindly introduce Vikram ji to the audience. Ankit.
Thank you, sir. Yeah, thank you, Papa. It is indeed my honor and to introduce Mr. Vikram Dhawan, a veteran of commodity markets. Vikram is a BE Mechanical from Nagpur University and also a PG diploma holder in materials management. He is a fund manager, head commodities at Nippon India Mutual Fund, erstwhile Reliance Mutual Fund. Vikram has over 2 decades of experience in commodities, fund management, enterprise risk management, and investing in corporate and banking sectors in India and abroad. Vikram has had various roles in Reliance AIF Management Limited, Reliance Capital, and was managing the risk portfolio with Gold Matrix PT Singapore. With this, friends, let us welcome Mr. Vikram Dhawan. Vikram, sir, over to you.
Thank you very much, Ankit. And I think very well said by someone that to learn and unlearn. First of all, I hope and pray that all of you are good and safe, and so are your families and near and dear ones. Well, learn and unlearn. Friends, past few weeks, we have seen a lot of strange things. And I think one of the most strangest things that we saw was the crude oil prices trading in negative. This is the first time I've seen, at least in my career and in the history, that I've at least followed the commodities. And this is something probably we'll carry with us and tell our grandchildren also, and beyond maybe. But to be fair, most of us who follow crude oil market very, very closely, this did not come out as a complete great surprise, because what was happening was that few weeks before this actual, the negative prices episode unfolded, crude oil, physical crude oil, parcels were actually changing hands at next to nothing. Why next to nothing? Because crude had already dropped below $40, $30. And there are a lot of crude grades which trade at anywhere between $10 to $12 discount from Brent to WTI. And then there were suppliers and traders which were on top of the discount were absorbing the freight and the, the storage also. So crude had actually was worthless before this episode happened. But why this happened, the real explanation of it lies 10, 12 years back. There's a bit of a history. And let me put my timer because I should not exceed my time given. There's a lot to say. Yeah. So why it happened, I have to take you 10, 12 years back for a few minutes. Post 2008, rather before 2008, 2007, US was one of the largest importers of crude oil in the world. And what happened in 2008 was that the interest rates went to zero, and natural gas and the price of a lot of inputs, including energy, they crashed to historic lows. So shale gas. Now, what is shale gas? Shale gas is nothing but oil which is trapped into rocks which are below the earth crust. And what you have to do is you have to dig, very deep holes, miles and miles below the earth crust, and you have to pass steam at a very high pressure, and then you break the rocks, and then you separate oil from the rocks. Well, it's not as easy as I'm saying, but yeah, it's a simple explanation of shale fracking. So prior to that, shale gas was not viable below $60, $70 per barrel. But after 2008 crisis, the shale manufacturers, shale producers got very cheap capital, almost 0%, very cheap natural gas, which is one of the inputs. And that is where the shale revolution of US started taking hold. And from 2008 to 2012 and 13, what used to be a 500,000 barrel, 2 million barrels on and off capacity threatened to become 5 million barrels per day, and also threatened to make US from a largest importer of crude oil to be an exporter. Now, this did not go well with OPEC and Russia, because you have to understand that oil is all about geopolitics. In oil, technical analysis, fundamental analysis works, but what works most is geopolitics. To understand oil, you have to understand geopolitics. What they did was OPEC went after the the shale gas production. If you remember, the rates started going down in 2014 and they remained low till 2017. We had a $50, $40, $30 sort of in oil at that point of time, and very volatile. They tried to kill the shale gas, industry in US by OPEC increased the supply to kill it. But in 2016, something happened in which OPEC had to, beat the hasty retreat. Donald Trump got elected, and Donald Trump's main constituency is Midwest, the Permian Basin, where most of the shale gas of US comes from. So that they understood, since now we have a Republican president elected from the Midwest, there is no way shale gas is going to go down. So they took a backseat in 2016-17. They started cutting production, and that is how the bull run of 2017 started. And oil went from $30 to $80 in a period of 1.5 to 2 years. But then shale gas today has, before the COVID crisis, shale gas was threatening to become so big. I mean, today US has become the largest, by far the largest producer of crude oil in the world. At one time, it used to be the largest importer of crude oil. And the shale oil is actually threatening not only OPEC, but also Russia and other countries, other producers also. So in 2019, OPEC and Russia decided to once again attempt to, scuttle or, try to reduce the capacity of shale gas by once again, first what they did was, first they decided to cut the production. They said, okay, shale gas is there. We accept it. Let us, let's now accept that, okay, shale gas will be there. We will have to now cut production, OPEC and Russia. And they started doing that from 2017 to 19. But what was happening was that whilst Russia on paper was agreeing to cut productions, but in reality, they were not complying. Now, this created a big friction between Saudi Arabia and Russia. And that is how the 2019 oil war broke out between Russia and OPEC. And, they said, okay, let's both produce as much oil and see who survives, who dies first. But then the COVID crisis happened. And what started as a Russia-Saudi oil war now has, actually America has become the collateral damage in that. Now at these prices, the shale industry of US is, staring at the blink of decimation, if not extinction. And in terms of how much time each producer can hold at these levels, well, at the current level, Saudi Arabia has got enough reserves to hold for 2 to 3 years, although it will, significantly break the back of their economy. They can hold on for 2 to 3 years at these levels. Russia can probably hold from another 1.5 years at these levels. But it is America. Now the elections are coming by end of this year. So probably it's the US. The elections are coming by the end of this year. So they have to make a decision before the elections, whether to cut their production or whether to exaggerate this war and bring the oil prices to even further lower. So what started off as a very interesting, what started off as a Saudi-Russia oil war now has got America in a crossfire. Now the dilemma with the Donald Trump government is that if they cut production and the election is coming, they'll be seen as a weakling owing to the pressure of Russia and Saudi Arabia. But if they support the shale industry, now before the COVID crisis started, the shale industry already had doubtful loans of roughly $200 billion. Add that to the $4 trillion, $6 trillion stimulus which the American government is thinking about. If they support the shale gas even further, then they are just delaying the inevitable. So probably the end game has actually begun. And if you really ask me that when this end game will finish, I think there's a very good possibility from now till September, October. Somewhere from now or September, October, either of the three things will happen. Either you will see America conceding ground and cutting production and curtailing, mothballing their shale production for a longer period of time, which again will take the crude oil prices higher. Or you may have a situation in which Russia is slightly weaker hand than Saudi Arabia. They might blink first and agree to join. Or the third scenario is that you have Saudi Arabia and Russia and America. Mind you, put together, these three control roughly about 40% of the global production, even without OPEC. If you add OPEC to it, OPEC plus Russia per America is about 60% of the global production. It's a lot of weight they carry if they want to manipulate the prices. So either of the three scenarios will play out from now till September, October. But what is also happening now is that the capacities, the storage capacity across the world in oil are almost full, and there'll be no place to store oil from anywhere between midway to end May. Even in India also, our storage capacities are filled up to 90-95%. So yeah, so the end game has started, but I think you will see that end game panning out in the next 3 to 6 months, and once that happens, probably in the what follows after that, you'll see the oil prices coming back to $50 or even higher. That is as far as the oil is concerned. And in the near term, at least in my 25-year-old career, I have never seen such bad fundamentals of any demand-supply imbalances of any commodity so far. The situation is so bad that crude oil prices can again go to zero and negative in the near term. So yeah, so that is as far as crude oil is concerned. Now, on one end of the spectrum, you have crude oil, where people don't have place to store crude oil. On the other spectrum, you have gold. There are no bars available. Today, if you want to buy Swiss or European or North American minted bars, they're not available unless you want to pay premium. Just to give you an example, if you want to buy gold coins in Australia, Singapore, or North America, there is a waiting list. And not only there's a waiting list, there is a 5 to 10% premium on that. Even in India also, if you see, physical bars are not available and they're trading at a very, very steep premium. And why this has happened? What has happened is because of the COVID, you have curtailment of production in gold refineries and gold mines. Roughly about 10% of the production is offline because of COVID, combined refining and mining. But that is met with an absolute investor frenzy in gold buying, the kind of buying that we have not seen for maybe 10, 20 years. Gold funds, they have received consecutive positive supply of positive inflows for around 4 weeks. So this is something unprecedented what is happening. Why people are going crazy after gold? What is the reason for that? Before I discuss that, come to that why there is so much of investor frenzy and craziness about gold this time around. There are a few things which I would like to run through you before I answer that question. First of all, why should we have as an investor? Why should we even consider gold? Is it something worth, or why should we be having? Well, people all buy gold in form of jewelry, gold bars, and something else. But should we consider, is gold a bona fide investment asset class or a security? So, instead of doing a very detailed analysis, what I've done is I'll just take you through 3-4 points which sort of evaluates gold as an investment, as an asset class, as a security. So let's see. In terms of track, so whenever you evaluate a security, there are 3-4 checks you do. These things like what is the track record of the security, what is the liquidity of the security, how will it fit into my portfolio, what kind of protection, hedging, what is the store of value, etc. All those things that you do. So let's start with the track value, the track record of gold. What has been the track record of gold? So till the early 1970s, the gold standard was very much prevalent, and US was the last country to have that. And what used to happen in the gold standard was that if you were before 1971, if you were holding a US dollar bill, a note, then the US Federal Reserve was obliged to convert that into gold. But it was discontinued in the early 70s because of two reasons. First of all, it became a cheap source for high quality gold bars for people, and everybody was, there was a run on the gold reserves of the US. And secondly, in gold standard, the amount of money which could be circulated or printed, it has to be in a ratio to the gold that you were holding. So you could not print unlimited money. So that sort of crimped, or held back the ability of the central banks to print their way out of trouble, as what we are seeing now. In spite of any material change in the reserves world over, there's still, I'm sorry, there's some disturbance coming in the background. Can you please mute your call? Thank you very much. So, like now, central banks have, created a stimulus of $8 trillion and counting, without any recourse to the reserves that they have or gold that they have, which you cannot do if you have a gold standard. So, how has gold performed since the gold standard was abandoned? So, that's been like 50 years now. So, in 50 years, post the abandonment of gold standard, gold has given a return of 10%. This is without compounding. So 50-year returns of gold are in excess of 10%. 20-year returns of gold are in excess of 12%. 10-year returns are in excess of 8%. 5-year returns are in excess of 11%. 3-year returns are in excess of 15%. And we know what happened in the last 1 or 2 years where gold went up by 50%. There's a very long track record of gold, and there is no reason why that should play out in the future also. There's a lot of explanation why gold goes up, but I think one of the explanation, and there are various explanations for that. One of the explanation is that the amount, gold is also sort of a currency. It is the oldest currency known to humankind. So whilst the supply of gold is limited, but the supply of the fiat currencies like dollar, rupee is unlimited, theoretically unlimited. As the amount of money supply or money printing increases, the currencies tend to, either through inflation or through excess supply, they depreciate against the gold. Or the other way, gold appreciates against these currencies. So there is a very long-term track record as far as gold is concerned, but one has to be very, very careful here that whilst gold has given long-term returns in double-digit terms, but we should have, but realistically, I think going ahead, one should only expect about 7 to 8% returns in the longer term. Why I'm saying it is because, first of all, most of these returns have been colored by a very strong bull run which happened in gold in the past few years. And secondly, what we have seen this phenomena that after every financial crisis, the long-term returns of each asset class taper off, whether it is bonds or equities. And I think similar thing will happen in gold also. So what used to be 10% historically may go to 8%, 9% or something like that. So if you have a return expectation in the vicinity of 8 to 9%, there's a good chance that you won't be disappointed, and probably there'll be phases where we will be surprised on the upside. Now, in terms of liquidity, how liquid is gold? Well, first of all, gold is the only asset class or security which can be traded even when the exchange is closed, and it can be traded anywhere across the world without any material erosion to its value. Also, in terms of statistics, whilst there is a market on exchanges, whilst there is a market which is there's a physical market, but there's a very strong, very large interbank market also in gold. So in terms of liquidity, gold is as liquid as S&P 500 index or Dow Jones index or maybe short-term US Treasuries. So that's saying a lot about gold, that it's a very, very liquid instrument. But then this liquidity of gold, the attribute of liquidity sometimes goes against gold, because what we saw in mid of March, that when the selling in equities and risky assets accelerated and people could not offload their riskier assets, then they started selling gold to raise cash and to pay for their margins. And this kind of phenomena will always happen. Whenever there is any liquidity freeze, whenever there is crescendo of deleveraging, gold may be the last person standing, gold will not be spared. But historically, whenever gold is corrected during any crisis, 2001 or 2008 or even now also, whenever gold is corrected in any financial crisis, that has been an excellent entry point. And anybody and anyone who has bought out those corrections has outperformed most things, in the investment universe. Now, in terms of portfolio hedge, or how does gold fit into my portfolio? There's a lot of studies being done on that, and I think each portfolio is different. It's very difficult to, impart a mathematical equation to you that this is the amount of gold you should have in your portfolio. But I think one of the studies which has been recently done by World Gold Council, and what they did was they took a hypothetical balanced Indian portfolio with the intention of giving in excess of 9% returns over the longer period of time, and they said that their analysis said that if you add gold anywhere between roughly about 5 to 15%, not only enhanced the long-term returns, but it also, significantly moved up the risk-weighted returns, i.e., it reduced the volatility of returns on the portfolio. So yeah, there are lots of studies being done, and each portfolio, as I said, was different. But this is one study which is available on World Gold Council's website. I would welcome you all to have a look at it. Now, in terms of inflation hedge, well, nobody knows better than Indians about the inflation hedge. In fact, there's a standing joke in the gold industry across the world that whenever there is a financial crisis, the Indian households, especially the Indian women, which are the largest holders of gold in the world, tend to outperform everybody, even Mr. Warren Buffett also, with due respect to him. So yeah, so I think one of the reasons why we are attracted towards gold is because gold is a very good inflation hedge. A gold bar the size of your smartphone, if you have a slightly larger smartphone, it'll weigh roughly about 2 kilos. That kind of a size of a gold bar had a market value of roughly 30 lakhs 10 years back, and now it has got a value of about 1 crore. So this is something which is very visible to the retail investors, and that is what attracts them to gold and this is what is the inflation hedge you can call, or you can call the store of value. There's one very important thing that we need to consider about gold, and that also explains why gold bull runs have so much of momentum. That is because gold is held by very, very strong hands. Today, out of the 2 lakh tons of gold which has been mined officially, roughly about 40,000 tons is held by the central banks. 4,000 to 6,000 tons is held by various funds in various forms. And then you've got various trusts and various families and all those things. So gold is held by very, very strong hands. And it's very paradoxical that whenever golds become more expensive, the appeal for the stronger hand even increases. That is why you see, in every gold bull run, there'll be a phase of a very, very strong momentum. The more expensive it gets, the more the strong hands want. But again, a word of caution that you should be careful when any of the strong hands are selling. If the central banks are selling, if the ETFs are selling, or if the large, family houses or if large institutions are selling gold, that's a time to be very careful about gold, because whenever these strong hands are selling, it could mean that a lot more pain is expected in the economy, because people usually sell their gold as a last resort. So there's a lot of attributes about gold which justify gold as part of your portfolio, and it ticks a lot of boxes in terms of a bona fide investment. Now, to answer the question why there is so much of frenzy in gold, why are people going crazy after gold? Now, I'll throw a very interesting statistic at you that in 2001, in 2008, and even in 2020, assuming we have seen the worst in 2020, the gold behaved exactly the same way in all these 3 financial crises. So in 2001, gold bottomed out before Dow Jones, bottomed out few months before Dow Jones bottomed out, and then it embarked on a bull run, 6-year bull run, returning about 240%. In 2008, again, gold bottomed before Dow Jones, and it embarked on a 3-year bull run, returning about 170%. These are all rough figures. Even in March, if you see, gold made a bottom of 1450 before Dow made a bottom of 18,000 something. And since then, gold has come up by about 20%. So what we have seen historically for gold, that it bottoms out before the equity markets. And even though the crisis is over, 6 to 12 months down the line, gold continues to rally. So this is the historic reference. This is the historic perspective the investors have. And that is why they don't want to miss the rally which may follow. But I think there are 2 things to it. First of all, we don't know the worst is over in the COVID crisis, which means if equities have not bottomed out, probably gold is also not bottomed out. That is one view you will have to take to enter into gold market. And secondly, very important, whilst historically it has happened in 2001 and 2008, there is no guarantee it will happen in 2020 also. you got to consider that also. So yeah, so because of this historical reference point wherein gold has bottomed before equities and rallied strongly after that, there is a very, very huge demand for gold. So yeah, so I think I have to talk about other commodities also. So I'll just move on to metals and then a bit of agri, and then we can take a quick Q&A after that. So we've already done about 21 or 22 odd minutes. So now, now shifting to metals, what is happening in metals? Now, while we are talking about, U-shaped recovery in, in oil, in metal is going to be an inverted U or maybe a A. Why? I'll tell you. So, before the COVID crisis, the metal industry was already in doldrums, whether it was steel, whether it was iron ore, with the aluminium, with the exception of maybe copper and nickel, which were being driven by the electric car revolution. Now we don't know, what's going to happen to that. So before that, except, or maybe if you take away a few precious metals and battery metals, the bulk of the metal sector was actually in doldrums, even before the COVID crisis. COVID crisis added to the worries and the problems of the metal sector. So what will happen is that, what we have seen historically, even after SARS also, that whenever the recovery comes, the recovery is very sharp and typically it inundates the supply. So you could see a situation where the demand for metals might outstrip supply for a shorter term. And you could see the metals rallying very sharply in the near terms. Near term, maybe 1 or 2 quarters. But I think that rally may not sustain. I'm not saying it will go down after that, but it will either stall or you could see some sort of consolidation after that. Why that rally will start? Because the lockdown across the world will not wind down as symmetrically. One country may open, one country may not open. So it's like tomorrow, if Latin America lockdown is not open, then supply of all the metals, iron ore, etc., will be crimped. Similarly, if Russia doesn't open, then the supply of nickel and platinum will be crimped, so far and so forth. And most importantly, what is the situation of the supply chain, the shipping industry? Not only shipping industry, the clearing and forwarding industry. Are there people there to to clear goods and bring it to the consumers? So this kind of friction may create a very tight metal market, which may give the impression that metals are very bullish. You may see a rally. How high? It's very difficult to say. But I think if you want to play this rally, you've got to be entering this early and exiting it early. There's no point, being late in this rally and catching it on the up. But I think what really the reason why I'm not extremely bullish on metals beyond medium term, unless something significant happens, is that there will be some demand destruction. There has been a clear demand destruction in oil and energy. There will be a demand destruction in metals. We don't know in which sectors. Well, most visible are aviation and whatever, hospitality and all. We don't know. There will be a demand destruction. And today, except the exception of 1 or 2 metals like maybe copper or maybe a little bit of nickel, there is no dearth of supply of any of the metals, even steel also. If the prices go too high, too fast, then the supply will catch up. I mean, you might see the metal sector disappointing after that. But there's a very big caveat over here. Now, of all the stimulus which has been announced across the world, we have to see how much of that is going into infrastructure. If a large part of that stimulus is going into infra, then you will see the prices of metals and cement, etc., getting underpaid. So yeah, so I cannot give you a very specific answer on the trajectory of metals, but I think and it's a very rapidly changing world that data is still coming in. Most of the investors are now actually flying blind. We cannot see. It's like flying an aircraft without instruments and there's clouds ahead of you. So you're flying blind. So yeah, as and when data comes, that you have to be very careful how you analyze it and how you invest into it. But you got to be careful in metals. That is my message to you. But not all the metals will correct. You'll have, if the battery, the electric car revolution catches up, then copper and nickel will do very well. To give you an example, I'll leave you with this example that in an electric car, the consumption of copper is 6 times that of normal internal combustion car. So you can imagine if tomorrow there's a rapid move to electric cars, there's not enough copper available in the world to catch up with that kind of a demand. So I'll conclude with my comments on agri. Agri has got the potential to create a tail risk. Why am I saying is because agri is a very domestic local thing for us. And again, over here, the lockdown may not be lifted symmetrically. It could be very asymmetric. One state may lift it, one city may lift it, the other may not lift it. So there is a very good possibility that you could have a lot of dislocation issues as far as agri is concerned. This may lead to a situation where the agri produce may not reach the consumer in time, and agri, unlike metals, is perishable. So there is a there has to be a very strong thought process that has to go while lifting this lockdown. It shouldn't happen that the farmers in Punjab are left with their harvest, whereas people in Maharashtra or in UP are left hungry for the want of it. This kind of thing has to be thought through. But already, any one of you are going down and buying stuff. You can see that there is some inflation creeping in as of now, and that remains a tail risk. I'm not saying that you would see a spike in the food agri prices, but if at all there's a risk in in the sub asset class of commodity, it is an agri to create a sort of a nasty surprise on the upside and increase the inflation expectations. So yeah, so there's a lot to talk about, but I think I'll conclude my presentation here. And if you have any questions, I'll be very happy to answer.
Thank you, Vikram. Of course, we had a very limited time, but still you tried to cover. Some people are asking about silver. I mean, that is the one question. Some comments, your comments on silver investment?
So silver, first of all, silver investment takes a lot of patience because, silver is both a precious metal and it is also an industrial metal. Silver has been in tight supply for the past 3-4 years. And that is why you will see a lot of commentators saying that buy silver, but silver is not moving at all. Ideally, silver should be much higher than what it is right now, if you see the fundamentals. Why this is happening is because silver is not a very big market. If you see the market capitalization of silver, it is about 15-20 billion only. Now today we're talking about companies like Google, etc., with a market cap of $1 trillion. So you can imagine, see, anything will move if it attracts large investors, large institutions. So for instance, today, if something has a market cap of 20 crore or 30 crore, a company has a market cap of 50 crores, there will be a limit to what kind of interest it will have. So unfortunately, silver is suffering from its low value. It is not getting any love from the large institutions. But I think if you are patient, then I personally believe that one of the beneficiary of the opening of the lockdown could be silver. You could see silver finally making a move by end of this year. And in silver, we know what happens. It's not never in percentages. It is always an X, 1X, 2X, 3X. So yeah, if you are patient, and ideally, if you really ask me, the best way to hold on to silver is basically if you can hold a silver ETF or a physical silver, because futures would eat away about 8-9% of your returns on rollover basis. Or if you see silver, the silver curve flattening out, then perhaps go and buy silver as far forward as you can.
Thank you. Somebody has an observation that China is a buyer of gold and oil. They are accumulating and creating stocks there. So what happens if they stop? I mean, gold remains still attractive, and the oil, somebody should buy into the oil feature now when that uncertainty of that particular day is over.
So yeah, I mean, for gold, I actually forgot to mention one thing, and I can see Mr. Kothari over there, who's the king of gold. So I should not be saying it in front of him. But I think what is happening is that in gold, whilst there is a lot of demand from central banks and ETFs and funds and investors, the physical demand in Asia is very weak. So the numbers of China has come. So last quarter, the first quarter, Jan to March quarters, Chinese consumption was down by 50%. India, we have not even got the figures. And India and China put together consume about 50% of the physical gold. So this is as far as Asia is concerned. Whereas if you look at the rest of the world, there is an absolute frenzy for physical gold coins and all. Now the question is, once the lockdown opens, will the Indian-Chinese demand go back to what it was? Will it be below that? Will it be higher than that? We don't know. If the demand, it could be that the Indian consumers, latch on to the same frenzy as their Western counterparts, and you could see more buying in gold. or maybe the financial crisis will break the back of the common man to buy gold. So this is a big question mark on gold. And that is why I personally feel that while gold remains in a bull run, but you'll see the gold prices being very volatile from now till September, October. So you got to be very careful as far as, putting all your eggs in basket. And same for oil also.
Thank you. We are very fortunate to have Prithviraj Kothari with us. And Prithviraj, as you know, for us, gold means Prithviraj Kothari. So we would like to hear from him something on this.
Yeah. Hi, Vikram.
Hi, sir.
I want to know about the gold monetization scheme of India, because India household having almost a temple trust and having the 23,000 of tons or more than that. So how your thought that the government should like to improve the policies and everything to curb the gold import and also curb the current account deficit? So how, any idea that government should go on how to go with the gold monetization scheme? Because the almost interest should be 2.5% on gold per annum. So is the better interest better than any in the world? So any idea how to develop this gold monetization scheme? Because this is not a success. It's only the 6 or 7 tons coming in the gold monetization scheme. So what your view on that? How to develop this almost 23,000 tons of household? How it come back to the government policies? And every time we depend, last 25 years, we depend on the gold import side only. So it's import curb, the current account deficit also cut. So what your thought about that?
Right. So I think most of the gold which is held by people, especially the large account, is very old gold. So if the tax authorities insist on paperwork and all those things, nobody will take out that gold, because ultimately, if by declaring my assets I'm going to be in trouble, nobody will come forward. So there has to be some relaxation as far as the CBDT is concerned, the tax authorities are concerned. And I'm not saying that, you sort of start laundering gold, but some thought process has to go wherein people, somebody who has got a net worth of, let us say, 1 crore, and if he's holding gold plus 20 lakhs, why he should be, it can be the other way around. Somebody has a net worth of 5 lakhs and he's holding gold worth 10 crores, then probably it rings the bell. But some sort of a rationalized scheme should come in that, up to a certain amount, a household should not be questioned कि तुम ये सोना कहाँ से लाए, किधर से लाए, इसका पावती किधर है, ये सब किधर है. So if these kind of things are actually thought through, then at least, I'm not saying all the 23,000 tons will come, but at least 10, 20, 30% of that come, which itself is very large, So that is my thought process as far as this thing is concerned.
Thank you, Vikramji, for sparing your valuable time. Friends, we are a little short of time, and Raamdeo ji has also joined already. So I know that there are a lot of questions in your mind, but we might have this kind of a session maybe subsequently sometime with Mr. Vikram Dhawan, depending upon his availability of time. So thank you very much for sparing your valuable time. We are indebted to you. Thank you. With this, may I request Aakash to unmute Rajat, and I request Rajat Mehta to kindly introduce our second speaker, Shri Raamdeo Agrawal.
Hi, Namaste, Jai Jinendra. I am unmute. Is Raamdeo with us? Because I can't see him, and Aakash is also waiting.
Now, I saw his name in the list here in the participants.
Hi, Rajat.
Hi, Namaste, uncle.
Yeah, can you see me?
Yes, absolutely, we can see you.
Yeah. Right now I'm on iPhone. I'm just trying to put it on laptop.
Okay, so while you're doing that, I'll start an introduction for you, if you allow. Yes. So, good evening, everyone. We are very proud to have with us Mr. Raamdeo Agrawal on our JITO, JPF and platform. It gives me a great privilege to introduce Mr. Agrawal, although he needs no introduction. He is the co-founder and chairman of Motilal Oswal Financial Services Limited. It's one of the foremost financial services and broking companies in the country. Raamdeo ji would be amongst the very few people in the world who Warren Buffett must recognize by name and by face. He's amongst the only few. And he could be attributed to bringing the whole research concept and culture in India with research, a strong research backed, idea picking. He's a trendsetter. He has authored several books on finance and wealth creation, for which he has also been awarded as Rashtriya Samman Patra by CBDT. He has appeared on Wizards of Dalal Street on CNBC TV 18. An ever optimist and a very forward-thinking, progressive leader in the financial services space. He's our very own Shah Rukh Khan or Salman Khan of stock markets. And we are very proud to have him with us on JITO platform to get to know more about now and in the future.
Thank you, Rajat, for a good introduction of Raamdeo ji. Raamdeo ji, you know, we call him as a synonymous of equity research in India. In fact, he is the one who brought this concept of fundamental research, you know, and the way he has built in this whole portfolio is remarkable. So with this, Raamdeo ji, as we have discussed, please speak for about 15-20 minutes. And you only suggested that let us have more time for question answers. So please go ahead. Thank you very much.
Okay, just one second.
In fact, Raamdeo ji, I think, is in MB Valley.
Yeah. Okay. So,
yeah.
Please, good evening, friends. It's a pleasure to be talking to all of you. But I'm talking from Lonavala, MB Valley. So, internet connection at times is wonderful, but right now it is giving a little trouble. So, please be patient if by chance the voice drops or my image drops. But coming back to the markets, the market levels, I have always been clueless in the sense that whenever I think market is going to go up, it goes down in short run. And whenever I think it is going to go down, it goes up. So right now we are in that kind of a confusing state. And in any case, you know, this COVID trauma all over the world is on. And most of the market watchers all over the world, including US, are saying that the world is damaged a lot more than what the stock market is reflecting. So, so in that kind of situation, of course, we are not market timers. I never time the market. One of the things which is a, I would say, very unique feature of managing money or managing investment is that I never time the market. And when I'm saying that I've never timed the market, or more recently, I don't time the market, I actually mean I don't time the market. So I'm also tempted to or buy something thinking that this will go up and then we can book profit and again come back. So these things keep happening. But I never. Hello, Rajat?
I can hear you, uncle.
Yeah. So yeah. So don't shut off the thing. Otherwise, I get a wrong signal. I don't know whether I'm being heard or not. So so clearly it is a very confusing time, and yet we know that tragedy on the world scale is very, very large, and some of the businesses are completely destroyed. Oil is out of shape completely, from $65 to $15-20, struggling right now. And we had one of the biggest accidents. For a settlement, it went below $30-35 negative. So the kind of demand destruction which has happened in oil, which is running into maybe 30% or 35%, because people are just not driving, people are not moving out. So 100 million barrels a day, oil market is reduced to 75, 80. Nobody knows the right number, but it must it has just not happened in the history. Every single airline in the world is bankrupt unless it is owned by government. It is bankrupt, and you cannot actually cross the continent today. So this is unprecedented, and it has just about started. It's only 30 days old, and I don't know how long it will go on, and how intense it will be, and what all correlated damage it will do. That is one aspect of it. Second, the consumer side. See, ultimately, the world is not designed for, fundamentally, you must understand, world is not designed for lockdown. It is just not designed for lockdown. It is designed around us. And we as a consumer, we are 24/7, 365 days, 24/7. We are consuming, we are living. It is a human life, and around human life, everything is designed. But the demand from the consumer are two types: essentials and discretionary. So right now, what is happening is all the 7 billion people all over the world, they are of course passing the time and they are consuming a lot of things, and those things are basically essentials. And all the discretionary things all over the world has been completely discarded, whether it is flying, whether it is tourism, whether it is fancy clothes, fashion, entertainment, all the shows and everything have completely stopped. So clearly there is a massive damage to the economy, and this loss, every extra week loss is more than the complete month's loss. So a lot of people are deployed in construction and many things. I mean, you cannot even enumerate how many people have lost job right now. So I was today, in fact, one of the fashion designer, he called up. So he called up to say that from Delhi, and he said, Raamdeo, my my office is shut, and I'm not selling any high-priced 10 lakhs, 20 lakhs fashion design stuff. Now, what happens is this guy can survive, but what happens below? I mean, all the people, all the karigars and everything from UP and all, jari ka kaam karne wale or silai, bunai or design karne wale, they're all completely, completely without job and without income. So first month is fine. I think probably they will sustain, but second, third month will be far more painful. So there is a huge amount of economic loss, and people are displaced, and it will have impact on the consumer behavior. So basically, the world and our own economy is designed around consumers. And fortunately, consumers are 24/7, except that this discretionary consumption is something which is not essential on a day-to-day basis, and hence anything to do with the discretionary consumption is completely out of the window. Look at the aviation, look at the driving, look at the tourism. Everything is completely.
I think.
So how exactly now? Nobody. One of the other problem of fear. Till there is a antidote to this particular problem, the consumer will not come out. You can stuff money in his pocket, but the consumer decides not to move out because of fear of his own life, and hence consumer behavior will change. And if consumers don't come out, if they don't drive, you cannot make them drive. So they will not consume the petrol or diesel or whatever. So clearly, there is much more lasting effect, and the damages are going to be quite staggering. And maybe because knowing that this is going to be quite serious, US government front-loaded the entire relief, seeing that it could be a 6-month problem or 1-year problem. Whatever they had in hand, they literally threw everything. Like they brought the interest rate from 1.5% to 0. They released $2.5 trillion of buybacks, and they released another 10-12% of fiscal benefit, even without asking, because they could foresee what are the problems going to be. So they should not be seen to be doing it even one day later. In fact, they have done it 1 month earlier. So there is a lot of confidence in what US can do. Of course, what US can do, others cannot do, but they have clearly attacked the problem with all the forces. Right from day one. And of course, it must be something to do with the US presidential election also, because that is coming up at the end of the year. So he doesn't want to see that markets are collapsing. So clearly, there is a stimulus to be has been given to the US markets and US economy, which is all world market. Because today, all the investing is interconnected in the whole world. So the moment FI starts hammering by 3,000, 4,000 crores per day, I mean, you cannot sustain. And the only relief, I mean, the market started recovering the moment FI is selling, stopped, or it became very, very moderated. So clearly, world is now interconnected. We are looking at US, what's happening in US, and that is what is giving direction to our markets. And US itself is floating in immense amount of liquidity, cheap liquidity, and hope that this problem will be sorted out much earlier, and looking for the vaccine. Or I think there is a lot more hope than what is the reality on the ground. Maybe I am stuck in MB Valley and I see the world far more darker than any other place. But clearly, this is not a 60 days problem. I have seen 3 collapses like this in my career. Rajat Mehta was very old back, and it was a very local kind of stuff. There was a big bull run, and 6 times market went up and it collapsed, and collapsed by 50-60%. And that time also there was a lot of chaos, but it was very speculative kind of a market. 2000 was a very global bull run on the back of Y2K. All the technology companies, they went through the roof, and it was a crazy kind of valuation. And then markets collapsed by 50-60%. And then on top of it, 9/11 happened. That broke all the back of the, and we had a serious recession, even in India in 2002-03. That recession was pretty bad. Then mother of all the bull run happened. Typically with this kind of correction, it lays the foundation for big bull run. And but it took 18 months for the markets to hit the bottom in 2001 to 2003. And then the third instance is 2008, when markets went up again to 20,000 Sensex. And so from there, it collapsed to 8,000, almost 65% collapse. That collapse was very, very serious. And the US went to very, very deep recession, and Barack Obama came as the president just as by ray of hope, and the bull run started from there. And it was one of the most envied and longest bull run, 11 years. We were not knowing how the hell it is going to come to an end, because this party had lasted too long. Nobody knew how it is going to come to an end. No inflation, full employment, everything was perfect. And this COVID hit the global economy. So now, but US went into recession with a completely high-flying kind of a growth rate of whatever, 3.5%, 4%, and perfect employment. Whereas we went into the recession or this COVID thing, when our economy was coming down, after this new government, we had all kinds of reform, demonetization, RERA, GST, and then IBC code, all those things, and the lower inflation, I mean the tightening of the monetary policy, all those things led to a much lower growth of about 4.5%. So we were already coming down in terms of trajectory from 8% to 4%. And then the COVID has hit you. So our own challenge is a lot more, because we had already a weak economy. On top of it, you have got the slap or the, so how exactly, I mean, immediately thinking by the government in terms of monetary policy as well as fiscal policy. I think on the monetary side, this RBI governor has been far more accommodative, and he has flushed the system with the liquidity. Now I think how to transmit the liquidity to the required sections of the society, they are working very hard, but at least there is no complaint about the availability of liquidity in the system. So that part is taken care. I think the fiscal side, they've been very, very careful. And one of the things is that today, the government finances are worst affected, because with the closure, we are the only country who have closed it completely 100%. So the GST decline is going to be quite staggering. And then on a 3 months, if there is a 3 months closure, literally at least 50 to 60% of the companies will have no profit in the current year. So when the GST falls by 50% for 3 months, typically 50% of the corporates will not have any profit for the whole year. So the direct tax decline will be even sharper for the whole year. So combination of fiscal GST decline and direct tax decline, I think they would have of the 12% of GDP by way of tax, I think at least 3% will not come to them. So on the 4% fiscal deficit, 3% revenue decline will make it from 4 to 7 in any case without doing anything. On top of it, whatever fiscal incentive, 10% kind of a fiscal deficit without much of stimulus. So that is because we have two things. We have already slowed down economy, and we had what do you call, full 100% lockdown of the economy. So the impact is massive. Companies will take a lot of time to come back and come to the, I mean, most of the companies who are hurt badly, cement, steel and all, they are saying that, sir, I mean, this year will go just, if everything goes right from here, there is no relapse or anything. In that case, this year will go just about in break even. And I think probably 21, 22, I mean, 2021 is a write-off and 21, 22 only they can think of. So clearly the damage is quite deep. And like you will see in today or tomorrow or day after, the total number of Maruti production is going to be literally 100% minus. So when this kind of data hits the street, then you see how much of optimism is left. Because this is like saying that right now there is explosion in the house. You can see the fire, you can see the flames, but you don't know what is the amount of damage. After the fire goes away, after some time, you realize how many bodies are coming out, what exactly is damaged, is there anything left? So that damage will be known only after some time. So I am of the firm view that this is not a 60 days problem or 70, 90 days problem. This is going to be much longer and probably as long as 12 months or 18 months, more like 18 months, I would say. So this is, if markets don't go down from here and if 7,500 is the bottom, I'm very happy, very, very happy because all the clients are, I mean, like buy and hold clients. So for them, the pain will be less. But I hope it works out like that. But generally, it doesn't work out like that. Whenever we feel confident, market disappoints you. So clearly, India has an opportunity to. India is a country of essentials. India is not a complicated country. It's a $2,000 per capita. The discretionary consumption is very little, maybe 1/4. 75% is essentials. So, but in US, it is other way around. Essentials are 25% and discretionary is 75%. So their damage is far more deeper and they will take a lot more time to come back. I mean, how do you restore Vegas, Las Vegas? How do you restore the conferences? How do you restore all the sports and all the conferences? So I think that is going to take a lot more time. Whereas here, the basics are very high. I mean, and our damage, thanks to good management of government in the health ministry, the damage is also limited. So clearly, we can come back very quickly, but that will require some kind of fiscal stimulus and more than that, the attitude of the government to really help the businessmen bring up the jobs. I mean, the kind of first guideline came that the officers will come and if one case is found, the factory will be sealed. I mean, that it is not about the process, it is about the attitude. You know, I mean, how do you see the businessman or the factory man or owners of the businesses as your partners or as some kind of a adversary? So I think if we are all together, the way we are fighting COVID, if we fight the slowdown together without much of politics in that, I think we can come back very quickly. And this could be a Y2K moment for India because the world is very unhappy with China. And it will have, again, lasting impact on them, their relationship with China. And India will definitely be preferred destination for a lot of businesses. But we have to be ready to welcome those businesses just by putting up a hoarding that, yes, they're welcome. I don't think it is going to happen. I think we need much more concerted effort on the ground to clear all the growth constraints for not only Chinese business, but Indian business also. Why my Indians are not producing for Indian consumption and importing from China? That has to be understood. Why they are not, I mean, earlier I used to see a lot of small businesses, small manufacturing companies, whether it is textilizing, whether it is looms. I mean, there's so many businessmen who are starting new businesses. Nowadays, I don't meet anybody. In fact, I meet more often people who are closing down. And I mean, maybe it is their own inefficiency or marketplace, but I think they need to understand from the government needs to understand this particular thing, why it is not happening. And once we change that attitude of the bureaucracy or regulators and people who are in execution in charge, I think if the way we are fighting COVID, if we come together, we can fight the job losses. And the way between 2000 and 2010, China was the story. Between 2020, 2030, India has a fantastic chance. Oil is 1/10 of the price, 1/3 of the price. Our forex reserve is $475 billion. We have fantastic resources in terms of manpower. Digital economy is also vibrant here. Nothing can stop if we are committed to bringing up the growth from 4% to 10% and do everything without politics to see that job losses are, jobs are created and businesses are flourishing. So with this, I will, bring an end to this. But just one recommendation about the stock market, since this is all about the stock market, that nobody knows if anybody trying to time the market will, at this point of time, the uncertainty is so much that nobody has any clue whether the worst is behind or worst is ahead. Nobody knows. So, but the COVID has come, COVID will go in 6 months, 1 year time. But the stock market is going to stay here only. And the companies which are there, good companies, they are not going to be one new company which is going to come in. So when the economy opens up from for the journey, further journey from $3 to $5 trillion, it is going to happen on the back of fewer companies. And hence, if you are finding a company which you understand and who has long-term potential, this is the time to buy them at half the prices or 60% of the prices and build your portfolio. So this is the time to put 10, 15% of the portfolio allocation which you want to do now. And then every month as the time passes, you can start adding more. More the fear, more you should become greedy. And as the time passes, you should be able to build the portfolio. And quite possible after you have completed your portfolio building, the market may still go lower than that. But then journey from there for the next 3 years will be much, much faster. I have seen from every bottom, the first 3 years are the most exotic, because then you are able to get 60 to 100% return for sure on the index level in next first 3 years. So that is an opportunity, and there is no way to know when is the bottom going to come, and hence wasting time in trying to figure out where the bottom is not the way to go about it. Seize the opportunity, understand the company, and start building the portfolio. Thank you very much.
Thank you, Raamdeo ji. In your last comment, you have answered some of the questions of the participants, because everybody was asking that if you are comfortable 2-3 years down the line, then is it not the right time to start accumulating? What will be the position after 6 months? Or which is the best way to build up a strong portfolio when you see that the markets eventually in next 2-3 years of time in India will definitely give fantastic rewards?
That has been the experience in the past from the bottoms. In fact, now the issue is whether it is going to be V-shaped recovery, U-shaped recovery, or L-shaped recovery. So, you know, what happens is that depends on what the government, what actions government will take. Now, we might be disappointed with what government has done, but we don't know what exactly government will do. So, you know, what happens is that in next 15 days, 1 month, 2 months, their cumulative action on the fiscal side could be quite staggering. Nobody knows. So, if the cumulative action on fiscal side is good and well targeted, we can have a V-shaped recovery where, you know, like what happened in 2008-9, it collapsed by 65%, but literally 60% it went up, almost the market doubled from there. From 21,000, it came down to 8,000 or 9,000. From 9,000, it went to 17,000, 18,000 in next 1 year. So that kind of a V-shaped recovery can happen. But what shape it will take, we don't know. It all depends on fiscal stimulus. Or it can be if the government doesn't do anything, it lives, they say that we cannot afford to put any money out there because dollar might go down or some crazy stuff. In that case, what will happen is the market will remain flat and it will not recover because you are not giving, because it's like a weak guy coming out from some kind of bimari. And if you don't give them the support, it will limp back. Of course, everybody will come back to life, but it will take much longer time.
Yeah, somebody, I think Rishabh is asking that with what is happening with so many mutual funds, including even the credit mutual fund, is it safe to invest through mutual fund, or it is better to pick up some good stocks directly from the market?
I lost you. Please repeat the question.
Looking at what is happening to the mutual funds, including some of the safe debt mutual funds, is it advisable to go through investing through the mutual fund or to pick up some good stocks directly, equity through the brokers? Instead of putting in the mutual fund.
No, so, yeah. Hello?
Yeah. So which is the best route? They directly...
Yeah, so, no. See,
I think there is...
Stock markets look simple, but they are very difficult. Hello? Can you hear me?
Yes.
Yeah. So the stock market is very simple. So it looks very simple, but it's very difficult. So so don't go for swim in a swollen river. Right now, it's a very deadly river, and anybody going without help has a chance of getting drowned, and you will not know how to come back to the shore safely. So I would think, see, if you are a master of the game, you have been managing your portfolio in the past, then you don't need any of the jokers from the mutual fund. You can do it yourself. Okay. But if you have not done it in the past, you can go to them and at a 1% or even less than 1%, 80 basis point direct schemes can get you all the mutual funds in the world. And there are some really wonderfully managed mutual funds out there. So it is better to go see than 80.
Again, there is some
20% return in the cause who is managing it. It is you are going to get because you are in equity space. You are taking the equity risk. So if you are putting out your money to take the equity risk, so you are going to make money.
Yeah, so, Vinod Ranka. Vinod Ranka, you have a question. You are unmuted.
Thank you so much. Raamdeo ji, Agrawal, Namaskar, Jai Jinendra. My question is, we've been talking about the stock market. My question is little evasive, and it definitely concerns stock market, but more important, it concerns the MSME segment, where the capital flow from the banks to the manufacturing units or the entrepreneurs is very bad. And secondly, the interest rate reduction, which has been done by the government, are being cushioned by the banks and not given to the customers. So what is your take on this?
So I believe that interest rate is of least important. Interest rate is not that important for most of the guys, because all these units, they are used to paying 8, 10, 12%. So that is not a problem. Getting actually the liquidity. I mean, if I want 20 crores for my working capital, or 10 crores for additional 10 crores for financing the inventory, or another 10 crores for kick-starting the operations, I think, I think credit risk. This is very crazy. I mean, you look at it, today, even Franklin Templeton is going down because of that, because everybody is washing their hands off. There is a paper, set of papers, and no bank wants to buy into them. And the debt market is completely frozen. So now there is a complete fear that any kind of a credit in the system is bad. Now everybody wants the money back, and nobody wants to live with the paper. That's how it's not going to work. And this is the kind of time when the central government, the RBI through the central government. What is central government? What is the government? Government is all of us, all 130 crore Janta. So anything happens to the central government, or say today he buys something of 1 lakh crore from the market and provides the liquidity to the MSME segment or any segment which is looking risky, and there is a 10-15% losses in that for the time being. Who bears it? The way you bear it for the PSU banks, when you give 1 lakh crore to PSU banks for all the losses, this is what is going to happen to them also. But that's how you run the economy. If you don't give the equity to PSU banks, you don't give the credit guarantee to all these mutual funds or the banks or anybody. Nobody will give money to anybody, and the whole thing will freeze out.
Tukkar, you have been unmuted. You can ask your question. Hemant.
Yes. Thank you, sir. Good evening, Raamdeo ji. My question is, in this, the way the corona is going, which sectors do you think you'll prefer to invest, or going forward, in the next 2-3 months, and how this pans out? But which sectors? See, obviously, consumer sector is badly hit, but there'll be certain sectors which are going to do well. What, according to you, are the sectors to invest?
See, when we are investing, we are not speculating. We have to build a portfolio. Okay, we don't know. As I told you, I don't know whether this trouble is going to last for 6 months or 1 year or 2 years, or it is going to break my back. Because today what is looking good, tomorrow it could be bad. You know, because I didn't know that crude can go to negative, but it happened. So the lot of risk. See, please try to understand how to manage the risk in your business, in your portfolios, because it is much easier to write the check, but you are writing the check with the hope that it will double, and then you'll get for 100, you'll get 200. But there is a risk you are underwriting. So you must understand the risk very well. Now, of course, you will understand the companies which you are buying, the business underlying, but the one most effective way, because individual companies, even best of the company can be hurt, let me tell you. Best of the businesses, best of the companies, best of the countries can be completely on the knees. You imagine country like Saudi Arabia, which produces 1/10 of the world oil. Today, when the price is $10, $15, what kind of country it is? It has come to the knees. They have to borrow even for their own day-to-day needs. So what I'm saying is, don't be speculative. Manage the risk well. And one of the ways to manage risk is make a diversified portfolio. And good time as well as bad time. Unless you know for sure, you're an insider or for some reason, you know that this company is worth 10, say you are a builder or something, you are in real estate. And you know this company is a piece of gold, but it is available at a completely throwaway price. And you want to bet your life into that. So that is a very different thing. But if you are trying to build a, if you are trying to make money in the stock market, you have to make a well-curated, diversified portfolio of 5 to 10 companies, 15 companies. So it will come from many sectors. I mean, some of the sectors which are running safe, say pharma, consumer, Nestle, levers and all, we'll still buy. So even at these prices, we'll put in the portfolio. And then some sectors which are hurt, like banks. Some of the banks are mispriced. Some of the NBFCs are mispriced. Insurance companies. So, and you know, whole lot of things, auto companies. I mean, today, auto companies have zero business. If there is one business where there is zero business, it's auto companies. You'll get to see tomorrow the production and sales of Maruti. But the stock price is not to zero. Stock price is still 50%. So I would like to see on 2nd April, what is the price of Maruti? When zero number comes, that time how much people have faith in the company. So we will definitely buy at some price. We will buy Maruti, will buy Eicher, will buy. So, you know, we'll build a diversified portfolio. So if quite possible, even if COVID is gone. See, now we are talking about selling it when the COVID is gone. But COVID जाने के बाद कहाँ consumer आएगा? वो किसको मालूम है आपको? Will people start flying? Will people start buying cars? Will people start buying homes? Will people go for new furnishing? ये हमको नहीं मालूम है. What will be the behavior of the consumer? So you have to buy just now, as we are saying, GDP in US in the first quarter shrank by 5%, minus 5%. So what I'm saying is that we are in uncharted territory. And this particular US GDP effect is only for 1 month. Not even 1 month, 15 days. You imagine for the 3 months, if it goes like this, what will be the US GDP? It might be 10% down, 20% down. So we are in uncharted territory. Don't be speculative. Build a nice portfolio and, and then stay on. Don't buy anything for 3 months. Buy for 5 years. It should be good for 5 to 10 years because we don't know how long is the trouble.
On this only, somebody has asked, and I think Prithviraj ji also, if he is there, which is better, gold versus equity at these difficult times and uncertain times? Investment in gold or equity?
You're asking me?
Yes, yes.
Yeah. So, you know, in investing, one of the things I've followed, and it works very well, do what you understand. मैंने कभी रियल एस्टेट नहीं खरीदा 20 साल में कभी भी एक टुकड़ा आप बता दो मेरे को I actually live in a rented house so I never had any surplus real estate because I never understood real estate और मेरे पास वो टाइम नहीं था कोई मसलमैन जाके उसको खाली कराने का या बचाने का चलाने का वो मेरे पास है नहीं so I said बॉस मेरे पास की बात में मैं नहीं करूंगा so वैसे ही क्या है gold is very simple but you got to be master of it. Gold has done very well in last 10 years, better than equity markets in India. But we are not buying for last 10 years. We are buying for next 10 years. So what will do well, it all depends on your comfort also. So I would not buy, but gold looks very interesting. I mean, for the current liquidities and the uncertainty and a lot of fear in the system, but it has also spiked to 1700 and all. So,
yeah,
because I don't understand. You ask somebody else about this.
Yeah. On this, actually, a related point on COVID, with this very controlled number of cases in India, and also the mortality comparatively only 3.25 or 3.5 of the less number of cases also, is it right to, I mean, according to you, to continue with this kind of strict lockdown, which is affecting economy very badly, Raamdeo ji?
भाई एक तो ऐसे unfortunate है that COVID has come, but the solution is far more dangerous than the disease itself.
Yeah.
We are poor country who's been hit by cancer patient. So what should he do? Should he stop going to the work? He's sick, or should he also work? So I think that in the lockdown too, they said there has to be a balance between life and livelihood, and that balance has to be very seriously looked into, very, very seriously. I mean, either you send the young guys only for work and let the senior guys stay home. I mean, they have to find some innovative ways, but you cannot stop the economy, because economy is 24/7. It is not designed for lockdown. The impact of lockdown is too serious, and it is impacting the government finances the most. So I think they must actually have all open, except for what they want to shut. Right now, it is just the reverse. You shut down and you are opening up by exception. I would say open the economy and shut down what needs to be shut down.
Hello. Yeah, Neeraj. Neeraj has asked the question. Neeraj, you are unmuted. You can ask your question.
My question from Raamdeo Agrawal ji: what is the future of listed general insurance company and business of general insurance in future after COVID lockdown or COVID era? After COVID era, what is the future of general insurance business and what is the prospectus of listed general insurance company?
So we are very positive on the outlook for the general insurance company, because when the economy becomes bigger, there are a lot more assets for it to insure. You know, I mean, insurance is a luxury, and that comes. I mean, that becomes bigger as the wealth of the country becomes bigger. So, this general insurance is a FMCG kind of company where you keep protect. I mean, many people come together to protect the assets of everybody. So that's how it works, and it requires a lot of brand equity, a lot of fixed cost, and and then competition is it is intense, but still it is not that easy to make money out of that. So the companies which are successful already, they are very valuable, and in years to come, they'll become very large. So I'm positive on general insurance.
Yes, somebody has asked about the public sector banks, especially some of the larger like State Bank of India or Canara Bank or Bank of Baroda. From the long-term perspective, how do you see the public sector banks, especially in the financial space? Raamdeo ji?
Yeah, it is a very tough question for me to answer, in the sense that, I mean, giving any kind of, one of the things is that the management is government. Now, giving your savings to be managed by governments, would you like to do that? So I think government is again not very good banker. I mean, these are banks who don't have incentive to create wealth.
But
who's kind of, and if there is any mistake or any default, the bill is borne by government. So, I mean, I would stay away from them. They are very cheap right now, but I would stay. They are cheap rightfully.
So you prefer some of these top private sector banks against the public sector bank, or the entire financial space only is not that attractive today?
No. The opportunity for the rest of the financial space, private sector, is going to be staggering. I mean, the bigger private sector banks, they are going to have, once this phase gets over, then I mean the loss is going to be for 6 months or 1 year. But after that, the future only belongs to them. Who wants to put deposit where? Where will you go to deposit your money? And if they say instead of 5%, if they say the savings rate is only 3%, what can you do? You can't go anywhere else.
Right. Very valid, this thing. You have to keep money somewhere at least. Yeah, Ravi, you had a question? Ravi?
No, thank you, Raamdeo. Thank you for coming into JPF platform. Thank you so much. And I have one question from Raamdeo कि पोर्टफोलियो लोकेशन किस तरह से करना चाहिए आपके हिसाब से, जैसा कि आप 100% इक्विटी में ऐसा रखते हैं, ऐसा मेरे को ये ऐसा मालूम है, किस तरह से पोर्टफोलियो लोकेशन ऐसा रखना चाहिए among gold, real estate or equity?
Yeah, so I mean, see, as I said, it is all about the comfort. I don't invest in real estate. I don't invest in gold. So I have no choice but to invest in equity. Or I had a choice between the debt also, debt and equity. So since I have a running company which is giving me some amount of profit every year, for me that is a kind of interest flowing in every year. So I don't need to again invest for cash flow. I have a cash flow. So I have invested everything in equity. That's the logic of my having equity. But for the person who's outside, hello?
Yeah, we are hearing.
Yeah.
Hello? Please go ahead.
Hello?
Yes, please continue.
So for ordinary people or people who are who have a different age profile and things like that, they can definitely balance between real estate, gold, equity, and debt also. So that depending on your
again voice.
Yeah.
Hello. I think getting 8-9% for a period of time should not be difficult.
Raamdeo, one question has come on what are your views on this home working culture which is started now because of the COVID forcefully? Do you see it? I mean, as if going to be adopted even for the future, for at least part of the staff, or this culture is going to be developed according to you, and is it not going to affect a lot of other things like commercial real estate and some of other companies which are depending on these offices?
Hello, I missed it, but I think the question was on working from home.
Yes, working from home. Yeah.
So I think this is going to be definitely a new trend. It is going to redefine the working space for a lot of businesses. And
I think again the voice there is some interruption.
Who are professionally qualified, who never worked. Hello.
Yeah, we can hear now.
Yeah, so I think it is going to be one of the mega trends, working from home, and I think the technology required, the cyber security.
I'll just do this. I think everybody is facing this problem. Some of those who are unmuted
kind of will be positively impacted. Hello?
Yeah, we can hear you now. Ashokji, we'll have to give it 10 seconds before we feel that it's not working, the network. Just 10 seconds.
Okay.
Yes, please, Raamdeo ji, please continue.
Yeah, so I think this is one mega trend, and there will be a lot of businesses created around this, and it will have a huge impact in the office space, home design, and some guys are saying that you need bigger space because now you have to put the distance between noise a lot more. So the same space is going to keep less people. So I think, but it is a bit, you have to see for yourself how it is going to impact. Hello.
Yeah. Ajay ji,
yes,
you have to say something?
I'm here. No. So we can go ahead. Yes, we can go ahead.
Yeah, so somebody was asking Raamdeo ji about the investment in the equity of IT sector as such, from the long-term perspective during this COVID time. IT sector.
Yeah, so I see in India, IT sector is all about the IT services to the global corporations. So I think they will fare better than a lot of other businesses because without them, none of the global corporations can ever work. So clearly, but then there are going to be visa issues, there will be travel issues, and whatever happens to the real businesses in US and all. So what will be the spending pattern, the kind of uncertainty which is there in the businesses in US and Europe, I think there will be impact on the projects which they are doing up. But I think longer term, they'll be much better off. They can work, they can deploy a lot of people from home, so their capital intensity can come down. Like TCS is saying that 3/4 of the people will work from home even after COVID. So I think it is a great time. I would think that technology itself will get a lot more prominence going forward. So apart from investing in Indian tech, one can also think of investing in NASDAQ, of which Motilal Oswal offers the ETF in India. So you don't have to go anywhere. You can buy in India itself as much as technology you want.
Can you elaborate a little more on this, Raamdeo ji? It will be very interesting for all the participants. On this
so
ETF
what I'm
overseas.
saying is that, so right now we are talking on thanks to fantastic platform provided by Zoom. So suddenly Zoom has become a $45 billion company. So like that, I think many more software is waiting to come in the future. And that will make working from home a lot more convenient, lot more reliable, and it will become a way of life. So I think, but we are going to ride on the back of technology. So the company which are digital technology companies are going to be flourishing. I don't know which one, and nobody knows right now, because this is an opportunity. Whenever consumer wants anything, the world will supply. So the technology companies will supply whatever you want. So my sense is that technology companies will do very well, and we have to be invested in them. And the best way to put say 10% of your portfolio into technology companies is by buying NASDAQ ETF, which is available in India, and it is incidentally provided by Motilal Oswal, and it is the best performing scheme in India for last 7-8 years. I think 12 years, more like a 22-23% compounded return has come. So it is a fantastic vehicle, and you can buy as much as you want, and it will not require company and all.
Yeah, Rakesh Ratadia, you have been unmuted. Just now we are taking just 1 or 2 more questions. You can ask your question, please. Rakesh Ratadia. If not, Raamdeo ji, there is another question. That in spite of Rakesh, are you there? So Raamdeo ji, the another question is that in spite of all this gloom and the COVID problem, which is absolutely unprecedented problem, and we are in absolute uncharted territory, why the markets in India are still holding on or rather going up from the lowest bottom? This is a question of someone here in the participant.
This is the most brilliant question, but I don't have any answer to this because I am as confused as the person who is asking this question. I have no answer, but let me attempt this. My sense is that massive fiscal and monetary stimulus given by US is allowing the world to remain liquid, and actually the alternative to equity is completely finished because there is nothing like debt fund. I mean, the yield on the debt in US will be a percentage or 2, and that too it will be risky. So what people are trying to do, people are running away from the debt all over the world. So everybody is saying that at 15-16 P multiple, the equity return has been so fantastic in the last 10 years. Maybe they'll get half of it, but they'll at least get the good return of 5-7% in US and all. And hence, there is a highest subscription to the equity ETF in US in last 1 month, record. And that is what is keeping the markets up. And we are also seeing now there is no more selling in the stock by FIs here. In last 25-30 days, I think the selling has completely stopped. And that is what is giving the hope. And when you look at the US future, it is up by 2%. Market opens with a gap. There is no news. In fact, the news is bad here. But US future is up. So you don't follow your own news, you follow the US future. That is what is happening.
Very true. Very true. Very true. Yeah, with this, I think we are coming to an end now. Raamdeo ji has also given more time than what actually it was scheduled. And really, you have answered everyone's questions, and you are absolutely, straightforward, focused. I mean, your views are absolutely candid, and everybody liked it. And just for the closing formalities, I would request Nikhil Singhi, the Zone Secretary of TN Zone, for a vote of thanks, formal vote of thanks. Nikhil, are you there? You are unmuted.
Yeah, I'm very much there. I'm very much there. Is my voice audible? Absolutely.
Yes,
so,
yes.
Raamdeo ji, we all are not going to forget the word which you used. We will come back very quickly. So, which itself means that this is just a small speed breaker in this entire journey of life. And I'll never forget what you just said. You do not want to do what you don't understand. And I think that becomes a very powerful thing to sum up your entire sharing and caring with us. Damage is deeper. The challenge is around not just for a few days, it's for 18 months. Consumption in the market will drive the entire industry. It's just like another moment of Y2K. And nevertheless, what you said, do not be speculative, and you need to have a diversified portfolio. So Raamdeo ji, there's no words to say how much value you have added to each and every Jain members over here, to each and every JITO members over here. Thank you so much, Raamdeo ji, for your valuable time, which you're sharing with us in such great detail. You're open to take so many questions, which is not a normal way of any speaker speaking. Thank you so much. And nevertheless, we should never forget what Vikram ji did with us. Vikram ji actually covered the entire commodity market in such a beautiful way, explaining in detail about the goal, from last 50 years till the last 2 months and the last 2 years, and even this year. And we all have understood about these different metals through him to understand how is that we are supposed to behave with these asset classes. But nevertheless, I'm not going to forget this title for today's meeting, which is don't do what you do not understand. So a sincere thank you to both our speakers with a lot of great Q&A, open Q&A. Thank you so much. I thank the JITO Professional Forum in association with Tamil Nadu, Andhra Pradesh, Telangana zone to conduct this kind of program for the benefit of our members so that they learn, they implement, and they try to go back with some value of all the time each and every one of us has invested. I thank you all the JITO members to really invest this valuable time to in between us, and truly looking forward for such more organized activities in months and years to come. So Raamdeo ji and sir, thank you so much, sir, for all your valuable time with us, sir.
Thank you, Nikhil. I am personally thankful to Rajat, Ankit, Ajay ji, Ravi, Ravikant ji. All of us together have made it possible with the help of our speakers, Raamdeo ji and Vikram ji. Thank you all the participants. Thank you very much, all of you. With this, we close this meeting, this webinar for JPF and our associates. Thank you.
Thank you.
Absolutely. Thank you all. Thank you all for your valuable